James Nixon is the chief European economist at Societe Generale. Joining me now, welcome to The Pulse, James. And you said in your note there may come a time when June's ECB meeting is seen as a lost opportunity. What could he have seized upon? Did you want to see interest rates cut? Did you want to see perhaps more bond buying?
Well, I think yesterday was really a missed opportunity in the sense that, he was a little bit disingenuous, saying there were downside risks and some of the data are headed south. That was on a day when from Spain we had, some of the worst, production figures in over 20 years, that kind of sense. So there's a sense of, some of these economies are actually falling. Having said that, I think, standing back from the situation, the timing was wrong for action yesterday, simply because obviously there's a lot of political pressure trying to be brought to bear on Spain, and whether Spain will actually, accept the conditionality attached to a potential bailout for recapitalizing the banks. But I still think the overall sense of yesterday's ECB meeting was one of, almost getting to the bottom of the barrel of the kind of policy measures, and the ECB are there to provide the safety net, but ultimately, there's this continued effort to make it up to the politicians to solve Europe's ills.
Still trying to put the ball very much in their court, but how efficient could monetary policy actually prove now if they cut interest rates? They are near lows, 1% at the moment. Could it really spur lending growth? Could it spur economic growth in Europe?
I think you have to say that, most of the ECB's sort of policy instruments, seem to be, pretty close to exhausted. You can't argue. Actually, overnight rates in Europe are already at about 0.35, 0.34. So, if they cut the deposit rate by 12.5 basis points, nobody can tell me that's really going to have a huge impact on the economy. At the same time, I think the LTRO is we're very well aware now of some of the inadequacies of the LTRO. Banks are nearing the, exhausting their limits of collateral, plus it subordinates some senior bondholders. So there's a sense in which, some of the ECB's main policy instruments have sort of reached, if you like, the limits of their efficacy. And that was clearly a point that Mr. Draghi made yesterday. There is the potential for the S&P and more direct purchases of bond buying. But I think to a certain extent it's been one of the hallmarks of his presidency that the S&P is not an instrument that the ECB is prepared to use aggressively. So it's hard to see in this stage what else they could do.
Hard to see what the ECB could do. Clear to see perhaps what the politicians could do, but of course it all takes time. Are you believing any of the speculation that seems to be rife out there that potentially Germany softening its stance might allow recapitalizations of the Spanish banks, might even see increased burden sharing in terms of what I think is a redemption fund?
I think potentially there is some movement in Germany. What I think people are perhaps not focusing on is that this isn't just going to be a free gift.
Yeah.
The point is that Germany will be prepared to perhaps offer up some of these sacred cows that previously has been resistance for, but they're going to expect something in return.
Yeah.
And in particular, I think that's going to be demands for much greater sort of structural reform. So we've already seen the huge emphasis placed on, if you like, fiscal rules. And what we're now going to see is the commitment to actually reform economies, do things like, potentially, raise pension levels, harmonize tax rates, and potentially reducing minimum wages. All these things that to a certain extent are, regarded as almost as the sacred cows of some of the European left. And I think those are going to be the quid pro quo for an agreement on some of these, basically on the principle of risk sharing in the fiscal arena.
But today we've seen a rally today. We saw quite a significant jump in stocks yesterday. A lot of speculation that it won't just be Europe acting, but we might see stimulus coming from the US. Of course, we have Ben Bernanke going to Congress later today. We had Bank of England as well. Are you expecting stimulus to become as a more coordinated group?
I don't know about coordinated. I think expectations of coordinated intervention are probably, oversold. I suspect we're in an environment where each of the global economies, to a certain extent, are responding to their own particular economic circumstances. I think in the United States, the Fed have made it very clear that if, for example, the recovery begins to stall, particularly if we start to see a plateauing in the unemployment rate, these are the kind of measures that would perhaps trigger further stimulus. And at the moment, it has to be said, we're entering a bit of a soft patch globally, which may be due to some of the problems in Europe, and some of those conditions seem to be fulfilled. Equally in the UK, I think the UK again does have an appetite for more quantitative easing, but at the moment the sticking point is still that that inflation is actually proving to be sticky. And I think we're looking for a little bit more downward movement in inflation. But given what's happened to oil prices, that also seems to be falling into place. So I think you can see, things are in chain, but whether or not they will be as rapid and as coordinated and as effective as perhaps the market seems to be, particularly getting the bit between its teeth at the moment, remains to be seen.
And very lastly, James, we've seen, where do you see Eurozone growth going? Because the ECB stuck to its minus 0.1% for this year, 1% growth in 2013, and he was optimistic.
No. I mean, I think the ECB was, as I say, a little bit disingenuous. You could say, optimistic. I mean, you look at the sort of the situation in Europe, and there's two observations to make. One is that what's not factored into either the European Commission forecasts or the ECB's forecasts is that not only is this year going to be a year of significant fiscal consolidation, but so is 2013 and potentially 2014. So you could be looking at negative growths, for example, in Spain, both this year, next year, and potentially into a third year as well. And then the second thing I think you have to highlight in Europe is when you look at the recent European Commission reviews under the excessive imbalances procedure, is the length of time that some of these countries are going to need to undertake the necessary adjustments. I mean, Spain is going to live with a situation where effectively domestic demand is going to be depressed to enable it to run a current account surplus for the best part of 10 years. So you're looking at a very, very projected, protracted, weak growth outlook for the Eurozone.
On that optimistic note, James Nixon, thank you very much for joining us this morning. James Nixon, Chief European Economist at Societe Generale.